All right, y'all. So I'm a little bit late, but I've been seeing a lot of posts and commentary on Brandon Turner losing $15 million of investors' capital. First and foremost, syndication is not easy. I know a lot of people like to take their victory laps and, you know, do the "I told you so's," whatever the case would be. I hate that energy. I hate all of it. It screams loser mentality, and I just can't deal with the negativity. With that said, there's a lot of lessons here, and I want to get into that. First of all, for those investors, it's tough, man. It's tough. You make an investment because you think it can help you and your family, and it can help you achieve the financial goals that you have. And that's the reason we do this. That's the reason we invest in real estate. There's certainly some simpler, uh, I don't want to say safer, but there's some easier investments you can make, right? But we know real estate is a tried and true vehicle that has been proven over the last, 80 to 100 years as one of the top vehicles to create wealth in this country. Outside of the stock market is definitely the next best thing. Apartment investing provides a lot of scale that's hard to get in single family investing. So there's a lot to like about apartment investing. When it comes to the syndication space, we are really looking at something that is unprecedented. First and foremost, apartment syndication, the way we know it now, is still a relatively new thing. The second thing, though, to understand is we have seen so many changes here over the last 4 or 5 years when it comes to, interest rates being at historic lows, to the amount of supply that's come online, that it is just a lot of moving pieces. And if you're not factoring all these things in, it can certainly be challenging and create situations where you can lose capital. Because the truth is, you can't control every aspect of investing. You can't control interest rates. You can't control supply. You can't control a lot of these things. There are three main factors that I see impacting not just Brandon, but a lot of investors in this space when it comes to how apartments are performing today. And the lesson I want you to take away is that apartments are not the problem. Syndications are not the problem. You have to understand how to identify and manage risk. And risk is going to be different for every deal. And if you don't understand the fundamentals of investing, you're never going to understand how to manage and navigate risk. So, first and foremost, the number one question every investor, particularly passive investors, have to ask before making an investment is, how can I lose money on this deal? You have to ask this question. All right. If you're not asking this question, you're never going to uncover where there's potential risk in the deal and how to mitigate the risk and how to get ahead of it, how to recognize when things are going awry, and how to cut bait if you absolutely have to. This is something you have to ask. I put together a guide of 7 questions you must ask before investing in apartments. And this is one of the things I put in there. Where can you lose your money? You have to ask this question. And in this case, without knowing all the ins and outs of Brandon's deal, and there are certainly a number of operators who are in similar situations, so this is not restricted to just Brandon. But for most people, what happened is people bought these deals, low interest rates. They bought it with variable rate debt, and those loans changed. Coming out 2021, 2022, and when that happened, man, it just got really tough on a lot of people. So with that on the rate and the interest rate, you have to understand, one, how do we control this rate? We bought some variable rate debt around that same time frame. One of the ways we mitigated that risk was we bought a rate cap. I don't know if they had a rate cap or not on this deal, but a rate cap is something that we bought. That can help a little bit. Now, rate caps got more and more expensive as rates continue to go up. So that's not the end all be all, but it's certainly one of the things that you can factor in. Outside of the rate cap, now you have to look at, okay, what about the expenses? What about the income? What's the business plan? A lot of folks are going to tell you, hey, the bridge debt is the problem. I'm going to be on a limb here and probably by myself and tell you, I don't think the problem was the bridge debt. I know it was variable rate financing. I know it changed. I know it's the thing that, made them lose the deal because they could no longer cover the debt service terms and had to get the keys back to the bank or had to sell it at a loss, right? But I don't think the interest rates and the loan itself was the primary problem. Here's why. the loan product has to match the business plan. Now, that business plan has to account for variable factors. And some of those factors investors could anticipate, some they could not. With tax increases, insurance increases, rent growth, and all these different factors. I mean, this is when we analyze a deal. This is what we're projecting. We saw interest rates shoot up. We also saw insurance and taxes shoot up, particularly in markets like Texas and Florida. I think those factors had just as much, if not more, to do with these deals run into the issues that they ran into, as opposed to just interest rates. Interest rates certainly are part of the challenge, but if you have a value add plan, business plan on a deal, you need to have the option to either refinance or exit of that deal. The reason these deals are so attractive, or these loan terms are so attractive, is because there's no prepayment penalty. Let me flip this and say it differently. If you bought a deal, you had fixed debt on it, but there's a prepayment penalty of, say, 2%, and you execute the hell out of the deal. And 3 years later, you get a phenomenal offer to sell, but you got to pay this 2% fee. You could be talking about hundreds of thousands of dollars, if not millions of dollars, just in prepayment penalties, right? So this is the kind of thing you do have to factor in as well, because that can really hurt. The loan terms are probably not millions of dollars, right? But hundreds of thousands of dollars you might be looking at. But that can impact your returns. And there is a risk involved in every investment. There are strategies. There's some educated guesses. There is, some tables of if this, then that, and, how do we manage this? But that's reality. You're going to take some risk in every kind of investment you make. Even bonds have some level of risk to them. And this is what investors are doing every time they look at a deal, is they're trying to figure out what's likely to happen and what's not likely to happen. And we have seen things that were probably not likely to happen, or most investors would have said they're not likely to happen. We've seen those things happen. We've seen interest rates shoot up more than they've ever shot up in the shortest window ever. We've seen more supply come online in the last 2 years than we have in the last 40, 45 years. It's incredible to have these factors come into play. And these are the things that really made it difficult for investors, particularly on this deal. For operators, though, and when it comes to the syndication space, the loan, it's got to match the business plan. For us, we like to look at the actual property, how much value we're going to be able to create with raising rents. We like the Midwest because we understand what's going to happen with taxes. We understand where insurance costs are going to be. We know that we're not into, areas where there's lots of floods or hurricanes and things that may cause insurance companies to raise their rates. You're paying attention to claims and things like that. So these are factors that maybe every investor isn't thinking about, but they do matter. They do come into fold. And when you're in Texas, that insurance is going to be huge, especially when you've had the amount of claims that have been filed over the last 3 to 5 years. So all these things come into play. And I'm not saying everyone can predict this, because it would have been really difficult for anyone to do that. I don't think that's realistic. But I do think it's important for people to understand, some of these factors when making investment. So when it comes to that initial question of how can I lose money? Well, you can lose money really just a couple ways. One, you don't have enough cash flow to cover the debt service, right? And if you don't have money coming in and you're not turning a profit on this deal, that's an easy way, an easy recipe to lose money. So that's the first thing you got to attack. You can do that with reserves. You can do that with how you underwrite the deal. You can do that with, how you're analyzing what your tax reassessment is going to be, what your insurance rate is going to be, how much rental income you're going to get. You've got to project all these different things, right? That is analyzing deals, and you have to factor that in. If you are too aggressive there, then you leave yourself vulnerable. The flip side of that equation, though, is if you are going to get that bridge debt, well, how do you flip that and be conservative on the other side? Well, maybe you limit how much debt you take. Maybe instead of doing an 80% loan to value, maybe you go down to 60. Maybe you do 50, right? So you've got to balance some of these things as an investor to mitigate risk in the deal. Particularly if you know part of your business plan is you have to refinance or sell in 2 to 3 years. If you know that's the case, then you've got to think about that as part of your business plan. And I think that is where investors make a mistake, is they assume the environment that they were in when they bought the property is going to be the same environment they'll be in when they go to sell. And you have these rule of thumbs of, oh, just add 10 basis points to the exit. Sure, that seemed good in a normal environment, 7, 8 years ago when many folks were getting started in space. That's not the reality. I mean, some of these cap rates went up, 100 basis points, 200 basis points, and not much you can do in that world. And when I say basis points, that's basically, you know, um, a hundredth of a percent, right? So you think about if it goes from a 4% to a 5% interest rate, well, that's 100 basis points. So, if we say 10 basis points, that's going from 4% to 4.1%. And when you're running your projections, you don't know. You're not going to know what the interest rate's going to be or what the cap rate's going to be 5 years from now. We're all guessing, right? So to be conservative, you got to take advantage or take a look at the most information you have and understand what would need to be true in order for this deal to go sideways. And then in that case, how do you protect yourself? And when you don't factor everything in to understand how the different pieces of the puzzle come together, that's where you can leave yourself exposed. And again, lots of investors have run into this issue, so it's not meant to single anyone out. But I do think you can mitigate your risk based on how you structure your debt, how you operate the asset, how you execute the business plan, and how you go about working and talking with investors. And quite frankly, pulling a cord if you have to early enough in the project so that it doesn't get worse before it gets better. If this is helpful, let me know. I mean, we try to sit down. We've got our multifamily mastery community. We talk about investing. We talk about underwriting deals, raising capital, and all those different things. And I just think it's important because so many people are using this as the reason you shouldn't invest, the reason you shouldn't do passive investing. And I just think that's a terrible way of thinking of it, right? Just because you don't feel comfortable working with other investors doesn't mean no one should. For a lot of people, this is the only way they're able to tap into passive income from real estate. And instead of doing fear-mongering posts and scaring people that, oh my gosh, this guy lost 15 million, this is why you shouldn't invest, let's educate people. Let's make sure we understand, learn from it, and get better. Because the truth of the matter is, if you are where you're at today and you want to change, you got to look at the options. And for a lot of people, investing passively is still going to be the best option. Now, learn from this. Maybe you don't want to invest in these types of deals or with bridge debt or whatever the case may be. Learn from it. Learn why it went sideways and become a better investor. Figure out your own investing philosophy, because every entrepreneur that I know, they are about experimentation. They try something that fails, they come back, they have success, they adjust. And you should not let a bad deal or a bad market or whatever you want to chalk this up to change your ultimate end game. And for many people, it's to create financial freedom. It's to have the time flexibility, the financial flexibility to be with the people they love, doing the things they love. And if apartment investing can help you do that, learn from this experience and learn how to be a better investor. Check out our channel. That's Multifamily Insights, and we'll put links to all of our stuff in our notes here. But hopefully this is helpful. Go out there and keep crushing it.